Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn & Associates with your financial market wrap-up for this Thursday, the 20th of July, 2017. We're at 3:25 p.m. Central Daylight Time. So the stock indices, I got grains on the mind because of the weather markets in them, but the stock indices, this is where the settlement prices are going to come in, even though they'll reopen in 5 minutes and trade again for a bit. Only the NASDAQ was up, the others backed off. Now, we did have European Central Bank announcements. Bank of Japan, they don't see themselves hitting their target until 2019. So that means a year and a half from now at the earliest is when they hope to get up. So their currency is going to sit back. And today it did finally roll down a little bit here. And I think that's important. It got up, as you can see, to 130.57. And by late in the day, the market was coming back to the downside, which I think is important. Euro currency, Mr. Draghi sort of caught in the Ben Bernanke scenario. If you'll recall, Uncle Ben created a bit of a tantrum in the bond markets when he started talking about ending the U.S. easing cycle that we were in and going to do interest rate hikes. Well, the cat's out of the bag because the market's looking at what Mr. Draghi said, and he comes out and they said, now the bank's holding where it's at. Their statement, not his press conference, said that even if necessary, the bank will add more funds. They're looking at things, blah, blah. So the market at first drops. Then, of course, the conference comes on, and the key question was about interest rates. Are they going to be discussed? They weren't for this meeting they just had in July. Were they going to discuss, though, later in the year, the tapering back of the interest rate, the stimulus cycle that we've been in? And the answer is it's coming up for discussion. That's all it had to happen. Bang, the market takes off to the upside. That was what they were looking for. So you get the higher euro, you get the lower dollar, you get the gold up a little bit on that news too. And the stock market, well, on the weekly chart, we're here where contract highs were up for the week, 15 points. Not a very big gain, but holding on to the gain at this point in time. And let's face it, it is an all-time high. When we come over to the daily bar chart, you're going to have a small reversal and close lower. But you still hit a new record high intraday, and you didn't lose much of that. So the momentum is still to the upside. And when you look at the swing lines, which look at, if you will, break lows and rally highs, you have a pretty clear-cut pattern of consistently higher lows, higher highs. That's bullish. What would hurt that? Taking out 24.54. So from where you're at, it's not all that far. I mean, if you really want to talk about it on a normal day, that's a move in the market. So if you were to break under that, my advice would be get a bit concerned because the market's saying maybe it's running out of momentum. Until it's broken, you're still in an uptrend. And even if it's taken out, here's the important thing. Even if it's taken out, what happens is you still have support back down at the 18-day average of closes. Now, what set this whole rally up was we had an outside day down on Tuesday. And my rule is if you take out the highs of an outside down within the next 2 business days, you got a problem. You took it out and you continued on to your higher high. Where did the market go to? As I mentioned, it has been riding the upper Bollinger Band, so I couldn't find another goal. The 100-day average is under the market. The 18-day is under the market. So there's not much you can do with that. In terms of momentum, you still have an embedded reading. So until this red line closes under 80, even if you take out 24.54, this is going to rule the day. So yes, you get nervous if you take out 24.54, but you keep your eye on that red line. Unless it crosses back under 80, expect to see professionals step in and nibble on the long side, throwing in the towel finally if that gives ground. That's what I think is how they might trade it. When I come to the Dow, I have the embedded reading as well. If we count the days here, Both numbers are over 80 today. Both numbers were over 80 yesterday, and both numbers the day before. So that's called embedded. Pullbacks in this market towards the 18-day average probably will be looked at as buying opportunities. Unlike the S&P, you're not trending to the upside. That's because you got a higher high and a lower low pattern. We see the bias is up because you're over the 18-day average, and you don't have to have a master degree or an IQ that's that of a genius to realize you're knocking on the door of all-time highs. You'd made that high a bit earlier here at 21,628, and you got within 4 points of it today, not that far away from it. In the NASDAQ, if you take a look at the high, it's a new all-time high. Are you embedded? Well, both numbers today are over 80. Yesterday, both numbers are over 80, but not the day before. You still have another day to prove that you can embed here. The market support, well, as long as you don't take out 58.20, and that's 100 points away, this market's still locked into an uptrend. The odds are it is going to embed by the end of the week. But when you embed, the one thing you keep your eye on is you don't want to see that red line get back under 80 on a closing basis. In the September Russell 2000, you're up to the upper Bollinger Band. You are overbought. No chance of embedding. Bull trend. I think pros taking some money off the table at these all-time highs. The problem has been, as you know, that a lot of people just feel I'm just going to hold on because it keeps going higher and higher. You can't argue with that. It's worked for years at this point in time. In the VIX, I'm still looking to see if this VIX can fall apart, and that's because you have the embedded reading. Now, I'm the first to tell you that falling apart is relative. When you've got a reading of 9.58, if you get a 10% drop in the market, you're only going to carry the market, down to 8.5. So everything gets relative the smaller the number gets, and very large swings in the market take place the higher the number gets. That's one of the reasons you're not getting a lot of follow-through, in my own opinion, on this market, but it is very much in a bear pattern, which is bullish the stock market. In the bond market, you're going to, I can't tell you the close, but you are up 8 at this point. You certainly have a bullish pattern of higher lows and higher highs. You're knocking on the door, but not there, and being overbought. You need to be over 70 to be overbought. You're at 68.32, but you're knocking on that door. Can the market reach up for the upper Bollinger Band? It could, but you're already overbought, so I have some doubts about it. Doesn't mean I'm right, of course. In the 10-year notes, the market's fluctuated back and forth all day with almost close to unchanged. It's very overbought. If it continues up, maybe you can get to the 126.22 range. I feel that the market more than that could back off for any reason at any point in time now that it's overbought, but it is in a bullish mode. In the dollar index, another big outside day down. So what happened today was once we got to the point where you saw what the European Central Bank and the Bank of Japan were doing, the dollar just caved in on it. Why? Well, the Bank of Japan doesn't matter to us that much. It's the European Central Bank that matters a lot more, and they're entering that potential tightening cycle where at least Mr. Draghi did say that the bank's open to discussing it in the autumn month. We call it fall, they call it autumn. Interesting. Lower highs, lower lows, under the lower Bollinger Band with an embedded reading. My key rule, I don't like going short under lower Bollinger Bands. I don't like buying over an upper Bollinger Band, but you can see what you've got. So another thing for both the dollar and the euro, you don't want to see today's low in the euro taken out in the next 2 days. And in the dollar, you don't want to see today's highs taken out. If you do, that would be a sign that maybe these markets have stretched out too far. So that's a warning sign. This market's got a bullish embedded reading. The dollar has a bearish one. British pound coming down. The number being thrown around is 100 billion euros. Whoa. To get the UK out of Brexit. That's going to be what they have to pay, from the sounds of it, to the ECB. And as you'd expect, they're not getting along with the ECB negotiators. Come on, this is not going to be an easy move for them. I've just been so surprised the market's been up from the fundamental point of view. I think that they've got a big road to hoe here, but we'll see what happens. The bias is up. Momentum is down. No trend. You got a higher high, lower low. The chart's a mess. That's the way that I view it. In the Japanese yen, classic what I teach, overbought, you're either looking for the closer of a major moving average or the Bollinger Band to stop a rally or offer a profit point potentially, and that's exactly what occurred. You're still very much in the uptrend, but you have an outside day down. You could be headed back to the 18-day average to regroup and see what the next trend is going to be here. In the crude oil market, I was on today, by the way, if you were watching Bloomberg at 9:15, I was on Bonnie Quinn today, and I was asked about the crude, and I was asked about the gold. In the crude, one of the things that I can't get away from is I keep looking at the amount of rigs that are out there. And, people, you don't need a rig for every well. You need it to drill a well. But just because you got a rig doesn't mean it's stuck on that. It moves around once the well's done. And what these developers, if you will, these producers of the oil are doing is they build a pad, and off that pad they're drilling a couple of wells. They're capping one or two of them possibly if they're doing several. They're using that one that they've got. People keep looking at it and saying, the production per well is falling. It's only falling if you add up all the wells and the wells that are already capped, not in use. But just like when we had this crisis and how fast we got things back up and going in our oil flow, those wells that they're drilling, all they've got to do is the second phase of it to get them back in operation. They won't need another rig. The hole's drilled. Got that? Quite important. Number two, remove those wells that they're drilling and look at active well production. I don't think it's falling the way people think. Technology's kicking it up. That's at least what I'm reading. That's what I see, and it's what I believe. But in any case, you got to the upper Bollinger Band. You're going into the OPEC meeting next week that we're going to find out what Libya is presenting, what Nigeria is presenting. We know that there's already a thorn for OPEC with Ecuador, as small as its production is at 500,000 barrels a day. They're still backing out of the agreement because they need the cash. How many others need the cash? But I'm looking at what's going on. Got up there, could back off. I just question if we haven't seen that the market's going to trade between $42 and $50 roughly, and that the market set a trading range. Gasoline, this is the summer driving months. You don't want to stand in the way of gasoline prices. You got an embedded reading. You got higher highs, higher lows. Yes, you hit the upper Bollinger Band and you backed right off of that. You had two resistance levels. Yesterday you hit the 100-day average, and now you're hitting the upper Bollinger Band. I think pros are taking money off the table, but I do think they'll rebuy on the breaks here. They're already talking, the EIA, that the current average price in the U.S. of gasoline is $2.28. They're talking it's going to $2.42 as the summer goes into the high driving season. Now, nat gas, big up day, and all of a sudden, big reversal in the market, okay? So, we didn't make it to the upper Bollinger Band. You're overbought. The odds favor it's going to get to the 18-day average and have to rebuild and tell us what the next chart story is going to be. And a lot of that's going to be covered in this great publication called Modern Trader. Now, it's broken down into trades, tactics, and techniques. After the bell, the different departments that you look at. It is for stock traders, derivative traders, option traders. I can go on and on. Futures, of course, FX. It's all there. Chart techniques, stories about what is going on, and then to give you your daily story, they put out this daily market focus, which is great because you're able to read the stories that are going on there. How do you get a free one-year subscription? They sent me, and I looked at an ad today for them. It's $79. It's free from us. I have a long-standing relationship with these good people. And how you get it is you go to our website at www.iraepstein.com. You can sign up for it. You can also click right up here if you're watching me on YouTube. You can call us at 866-973-2077. And under us on many websites it says, click here for Ira's free offers. Why not get a great magazine for free for a year? I think you'll find it well worth your time and effort. Remember, that's how you get to us, and we'll take it the rest of the way. You have a great day.